Stop what you're doing. Seriously, pay close attention. If you have a single dollar sitting in a traditional bank account right now, you are actively participating in a massive, silent wealth transfer, and you're probably on the losing side. Welcome to today's Explainer. We aren't just taking a casual textbook stroll through the 2026 global financial ecosystem. No, we are exposing the colliding macroeconomic forces that are literally pulling the strings on your money right behind the scenes. From central bank policy down to everyday retail accounts, the landscape is shifting under our feet.
Let's kick things off with a statistic that should honestly make your jaw drop. $1.3 trillion. That is the record-breaking net income the global banking industry just racked up going into this year. Now, on the surface, that sounds like a masterclass in business, right? But here's the painful reality for everyday folks. A massive chunk of that mountain of cash is built entirely on your inertia. They are banking on you doing absolutely nothing. But here's the twist. By the end of this explainer, you are going to learn exactly how a brand new wave of AI agents is about to completely obliterate this comfortable profit model. We'll give you a clear framework to understand if your money or your organization is positioned to survive the fallout.
To make sense of all this chaos and give you that actionable perspective, here is our game plan for today. First, we'll hit the macro outlook on rates and growth. Then, we dive into banking's record-breaking year, followed by the unconstrained tech revolution that's shaking it up. After that, we'll tackle navigating new capital rules, the ESG regulatory shift, and finally, wrap it all up with infrastructure and energy execution.
All right, let's dive right into Section 1. Macro outlook, looking specifically at rates and growth.
So to really understand corporate profits today, we absolutely have to start with the Federal Reserve's March 2026 projections. This right here is our critical baseline. We're looking at real GDP growth chugging along at 2.4% and unemployment sitting tight at about 4.4%. Now pay close attention to inflation, specifically PCE inflation, which is the Fed's absolute favorite metric for consumer spending. It's hovering at 2.7%. But the real center of gravity for all global capital, that's the median federal funds rate projected at 3.4%. It tells us loudly and clearly that central banks are staying heavily data dependent.
Meanwhile, across the pond, Europe is telling a completely different story. The European Central Bank is keeping rates steady, but they're projecting significantly slower growth, just 0.9%. Why? Well, they're walking a super fragile tightrope. They have upside inflation risks hitting 2.6%, and a lot of that is being driven by sudden energy price spikes linked to ongoing conflicts in the Middle East. So they have to somehow manage that inflation without completely crushing an already sluggish economy. It's incredibly tough.
Which brings us to Section 2, Banking's Record-Breaking Year.
Check out this insight from the McKinsey Global Banking Annual Review. The banking sector just totally outdid itself, hitting that wild $1.3 trillion mark we talked about earlier. Literally the most net income of any industry on the planet. But, and this is a massive but, we really need to put our critical thinking caps on here. This unprecedented profitability is basically a smokescreen. It's hiding some incredibly intense underlying pressures.
The numbers from Accenture reveal a truly massive spread. Banks have been making an absolute killing by paying out super low deposit yields, averaging just 2.1%, while simultaneously charging high lending rates around 6.8%. And remember, the benchmark rate during the snapshot was hovering around 4.3%. So what does that actually mean? Traditional banks are raking in cash simply because people don't move their money. Relying on asleep-at-the-wheel depositors to defend your liquidity? Yeah, that's a dangerously fragile business strategy in today's world.
And that fragility leads perfectly into Section 3, the unconstrained tech revolution.
Accenture's 2026 report introduces a concept that is a total game changer. They call it unconstrained banking. Think about it. For hundreds of years, banks have been locked down by the limits of their tech, their rigid organizational silos, and frankly, physical brick-and-mortar capacity. Well, those long-standing boundaries? They are finally completely dissolving. Just compare the old world to the new reality. For decades, legacy banks were bogged down by siloed data, insanely expensive manual compliance processes, and a massive reliance on physical headcount. But in the unconstrained reality of 2026, it's a whole new ballgame. We're talking generative AI, digital assets, and always-on real-time settlement. These tools are unlocking massive capacity at a fraction of the traditional cost, totally severing the link between growth and physical infrastructure.
So here's a rhetorical question that should keep every bank executive awake at night. Right now, over half of retail customers don't even know what their savings rates are. But what happens when AI agents take over?
Think about it. These AI agents will mobilize liquidity instantly, seamlessly hunting down and moving funds to wherever the yield is highest in real time. Remember that cozy 2.1% deposit rate we just talked about? AI threatens to vaporize that margin overnight. Sticking a safe and secure sticker on a bank branch just isn't going to keep deposits sticky anymore.
Okay, moving right along to Section 4, navigating new capital rules. How are regulators actually responding to all this technological and economic chaos? Well, according to PwC, U.S. banking agencies are pushing a new capital package that completely flips the script on how banks manage their requirements and understand risk. We are looking straight at the evolution of the Basel III Endgame, which is the major international regulatory framework, and the next generation of risk-weighted assets.
These updates are actually pretty nuanced. Surprisingly, they lower overall capital requirements, which is a big win for traditional lending economics, and they carve out specific tailored approaches for regional banks. But there's always a catch, right? The trade-off is extreme, mind-bending complexity. This new expanded risk-based approach means Treasury and data teams essentially have to tear down and rebuild their compliance strategies. They're being forced to be insanely sophisticated in how they assess risk in real time.
Next up, Section 5, the ESG regulatory shift. Because let's be clear, regulatory scrutiny is heavily expanding way beyond just capital reserves. We are witnessing a massive paradigm shift here. Looking objectively at the UK's 2026 ESG, or Environmental, Social and Governance Guidelines, the global trend is crystal clear. We are way past the era of optional feel-good marketing statements. If your company takes a hit in the supply chain because of a climate event or poor governance, regulators are now treating that as a strictly audited bottom-line financial vulnerability. No excuses.
So how do companies actually survive this shift? They have to ditch the tick box compliance and align with global heavyweights like the ISSB, the body setting these international standards. It's a very clear, actionable three-step process. First, you run an ESG gap analysis. Second, a robust materiality assessment, basically figuring out what actually hits the wallet. And third, a massive upgrade to data systems. Your ESG data now has to be bulletproof. It needs to be as rigorously controlled and audit-ready as your standard financial reporting.
Finally, let's bring it all home with Section 6, Infrastructure and Energy Execution. To see how this all plays out in the real world, we're going to look at a micro case study. Adani Total Gas, a major infrastructure platform over in India. We want to see exactly how they execute while navigating these global supply chain choke points, the massive energy transition, and those strict ESG mandates we literally just broke down. Remember that geopolitical volatility the ECB was warning about? Well, despite all that chaos in the energy sector, ATGL posted some incredibly rock-solid numbers. We're talking 6,415 crore in revenue, which is massive scale for the Indian market, and a really healthy profit after tax of 637 crore. It goes to show that you can execute with absolute discipline, even when global markets are incredibly volatile. But here's the real kicker, and how it ties directly back to that ESG regulatory push. ATGL isn't just sitting back managing its legacy gas lines. They are pouring serious capital into building out a cleaner energy ecosystem. They've aggressively expanded to 705 CNG stations and, get this, they've installed over 5,100 e-mobility charging points. This is exactly what it looks like when a corporation perfectly aligns its capital expenditures with both future market demand and strict new regulatory realities.
So, as we wrap up this explainer, the big takeaway is how deeply interconnected all this really is. You've got the Fed's 3.4% rate dictating bank margins, AI agents threatening to obliterate those same margins in milliseconds, regulators forcing hardline ESG audits, and infrastructure giants pivoting billions of dollars just to keep up. So I'll leave you with this. How are these colliding forces going to reshape your own strategic moves? Are you actually prepared to operate in a truly unconstrained financial ecosystem? Thanks so much for joining me on this deep dive. Keep asking the hard questions, and I'll catch you next time.